Right now, the stock market is super uncertain. Inflation is crazy high. It seems like eggs are $49 a dozen and everybody is freaking out. The media is screaming recession, people are panic selling, and retail investors are running for the hills. But guess what? This is exactly when the wealthy people are making their moves. And today, I'm going to teach you how to turn the so-called crash into your biggest wealth building opportunity with something called dollar cost averaging, or as I like to call it, when they panic, we buy. Stick around because by the end of this video, you're going to know exactly why the market always recovers, how to use dollar cost averaging to build generational wealth, and most importantly, why smart investors love when stocks are plummeting.
We getting money, money, money. When Jameer sharing gems with her getting money, money, money. Getting a line, growing money and getting money, money, money. It's your life, trying to get more life. Money, money.
Make sure that you like, comment, and subscribe if you want to learn how to invest like the rich. And drop a money bag emoji in the comments if you are ready to make some real money moves. By the way, you all have been asking for it, so I've gone ahead and created it for you. You can now download for free my list of 26 stocks that pay monthly dividends. The link is in the show notes and it's pinned to the top of the comments. Let's get started. Okay, let's kill the myth that this time is different, because it's not. The market has crashed before, it's going to crash again, and it has always recovered every single time. Check this out. Here are some of the biggest stock market crashes in history. The Great Depression of 1929. The stock market dropped nearly 90%, but those who stuck with it saw one of the biggest bull runs in history. Black Monday of 1987. The market plunged 23% in a single day. Yet within 2 years, it had fully recovered. The dot-com crash from 2000 to 2002. A lot of tech stocks collapsed, but a lot of the big hitters like Amazon, Microsoft, and Apple, they came out stronger than ever. Now, a lot of us remember that 2008 financial crisis where stocks fell over 50%. But if you stuck with it and stayed in the game, you'd be experiencing over 10x gains today. The COVID-19 crash of 2020. The S&P 500 dropped 35% in a month, but within 5 months after that, it had hit all-time highs. If nothing else, history proves one thing. The market goes through cycles, but over the long term, it always trends up. If you panic and you sell during downturns, you're locking in losses. But if you buy when stocks are down, you're setting yourself up for massive gains when the market rebounds. So let's talk about dollar cost averaging. What exactly is dollar cost averaging, or DCA? Now, this is going to be your secret weapon. It is the ultimate way to buy stocks, especially when prices are low, and it ensures that you don't overpay when prices are high. Dollar cost averaging, or DCA, is simply a fancy term that means you're investing the same amount of money at a regular interval, like every 1 month or every 2 weeks, no matter what the stock price is. Let me break this down for you with an example. Imagine you have $100 to invest every single month in a company that you like. So over the period of 6 months, here's what it might look like. Let's say in January, the stock price was $10 per share. That means your $100 is going to allow you to buy 10 shares that month, because $10 times 10 shares equals $100. Now in February, let's say the price of that same stock went up to $12.50. That means in February, your $100 would allow you to buy 8 shares, because again, $12.50 times 8 shares equals your $100. Now in March, let's say this stock is highly volatile and it dropped down to $9 in March. Well, in March, because the price is lower, you can buy more shares with that same $100. So in March, because the price is $9, that will allow you to buy 11.11 shares of your stock. Now May was a good month because May, the stock price jumped back up to $11 per share. And that's going to allow you to buy 9.09 shares of the same stock with that same $100. And then in June, we dropped down just a little bit to $10.50, which means that with that same $100, you're now able to buy 9.52 shares of your stock. Now, in this hypothetical example, over the course of those 6 months, you would have invested $600 into the company that you're buying into. And during that time, you were able to purchase 60.22 shares of this company, with the average price that you paid for all your shares over that period of time being $9.97. Even though, remember, in February, the price was $12.50. And in May and June, it was still higher than $9.97. In May, it was $11. And in June, it was $10.50. still over and above your average price paid. But because you kept buying consistently, your average cost per share was lower than the highest price during that period of time. And when the market rebounds, your gains are even greater. But if you had panic sold in February at $12.50, you would have lost money. But because you kept on investing, your cost basis dropped and you actually ended up getting a deal. And that, my friend, is the power of DCA. Now here's why smart investors love stock market crashes. There's a famous quote by Warren Buffett that says, "Be fearful when others are greedy and greedy when others are fearful." And it is one of my favorite quotes when it comes to the strategy of investing in the stock market. Most people panic when the stock market drops, but the wealthy, they get real excited. Because think about it this way. If Nike had a 50% off sale on Jordans, would most people get scared and run away from that deal? No way, of course not. They would stock up and stock up heavily. Yet when the stock market drops and essentially stocks are on sale, most people freak out and they sell at a loss because they're moving from emotion and not facts. And remember, on this show, I keep telling you, don't move with emotion. Move based upon historical facts and predictions of the future based upon those historical facts. So again, I'm waking up every day to be extraordinary. And if you're watching this show, you are too. We're not moving with emotion. We're moving based on fact. And we know that the market is always going to recover because historical data tells us so. And this is exactly why investors like Warren Buffett, Cathie Wood, and even big hedge funds keep buying when everybody else is running scared. Okay, so now you're wondering, well, how exactly do I use dollar cost averaging? How exactly do I turn DCA on? Turning on DCA in your brokerage account is super simple. Most brokerages will allow you to automate recurring investments. So you can buy stocks, ETFs, or even crypto on autopilot without having to remember to log in and do it manually. Here's how you set it up. First, you need to choose your investment. So you can pick a broad market stock or ETF like VOO, QQQ, SCHD, or TOPT, for example. The latter of which I have a whole episode on. If you'd like to check it out, you can click the link in the show notes if you are listening on podcast, or if you're watching on video, you can click the link above. In addition to ETFs, you can also choose any company or individual stock that you might be interested in, or even crypto. Speaking of crypto, DCA is one of the best ways to invest in crypto, such as Bitcoin, Ethereum, or any other cryptocurrencies without stressing over price swings. Since crypto is highly volatile, meaning it moves up and down with big price swings that can give you a lot of anxiety if you're watching it too much. DCA actually helps to smooth out those ups and downs by buying for you consistently over time. Next, you need to log into your brokerage account. Or if you don't already have one, you need to open a brokerage account. Some of the best and most trusted ones are Fidelity, Charles Schwab, Robinhood, Vanguard, Webull, TD Ameritrade, and more. Now, a quick word of caution. As of the time I'm making this episode, Vanguard does not allow you to invest in cryptocurrencies. So if you're interested in Bitcoin, Ethereum, or any of those, don't go with Vanguard because you won't be able to invest in it. If you don't care about crypto, then Vanguard is a very good option. However, if you would like to have crypto as an option, definitely choose one of the other ones I mentioned other than Vanguard. Another quick word of caution. I've said it before and I'm gonna say it again. I'm gonna beat this dead horse until y'all get it. Do not use Cash App or companies like it to invest your money. Their main business is not brokering, and for that reason, a lot of times they don't have a lot of the stocks that you're interested in. You will be very disappointed if you go to buy a certain company and it's not on Cash App or whatever company it is that you're using that's similar to Cash App, and then you end up having to spend your time opening up a correct brokerage that you should have opened up in the first place. Just do it right the first time, and that way you don't have to worry about it. Once your brokerage is open and you've been able to log in, you now need to go into the recurring investment section, or it might say auto invest. Some platforms call it recurring deposits or automatic investments. Either way is usually under the trade or the invest tab. So of course it's going to be in different places for different brokerages, but it's generally going to say something along the lines of automatic reinvestment, recurring investment, recurring deposits, something along those lines in your brokerage. And the next step is to set up your investment plan. Simply select the ETF, stock, or crypto that you want to DCA into, and then choose the amount that you want to invest, whether it's $50 a week, $100 a week, $200 every 2 weeks, $500 per month, whatever you decide. You get to pick the amount and you get to pick the frequency. The next thing you need to do, if you haven't already done it, is to link your bank account. You have to put some kind of money into it in order to buy the stocks, right? So ensure that you have funds available for these automatic investments. And then you just confirm and activate. Review the settings, make sure everything looks good, and then just turn on auto investing. Now sit back and let your investments grow. Now that you've set this up, your brokerage is going to automatically buy shares at the frequency that you set up. No stress, No FOMO, just consistent money stacking. Getting to the bag on autopilot is the smart way for you to be investing your money. Now, if you need more help setting up DCA in your brokerage, Google is your friend. Just go to Google and type in how to set up dollar cost averaging in Robinhood, for example, if Robinhood is your brokerage, or how to set up dollar cost averaging in Webull, or how to set up dollar cost averaging in Fidelity, or how to set up dollar cost averaging in Charles Schwab. Here's a pro tip. You're going to set it and forget it when you turn on DCA, but I still want you to check in quarterly. Once you turn on DCA, leave it alone. Don't mess with it. But every 3 months, I want you to check your investments and adjust your contributions if you need to. If you see that a stock or you hear news that a stock is going to rise, maybe you want to automatically invest more than you already are investing. On the other hand, if that stock or that ETF is losing and it seems like it's going to lose for the long term, maybe you need to sell it. But again, regardless of what the stock is doing, you are going to move from a place of data and facts, not emotion. Remember, when they panic, we buy. But only if the data tells us that's what we should be doing. Now you know how to turn on DCA and start building wealth automatically. Are you setting this up today? Let me know in the comments. Now comment DCA for me in the comments below if you stayed to the end. And remember, go ahead and click the link in the show notes so you can download my free list of 26 stocks that pay monthly dividends. I'll talk to you next time. Peace.